Good afternoon, you're watching Bloomberg Quint Live. I'm Alex Matthew and these are the headlines at 12. Markets erase early gains with both the benchmark indices trading more or less flat at the moment. Broader markets fall. Oil marketing companies are under pressure after Brent crude closes above $70 a barrel for the first time in nearly 3 years. Federal Bank falls over 5% after the bank reports a worsening of asset quality in the third quarter. IT stocks are the top gainers on the Sensex after Morgan Stanley upgrades the sector, citing they could be set for a turnaround in 2018. Now don't go anywhere. Hot Money starts immediately with Darshan Mehta. Darshan?
Thank you, Alex. Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts in Chintan Vora of Finance.com, Vinit Bolinjkar of Ventura Securities, and independent market expert Dharmesh Kant join us on the show. Thanks all for joining me on the show. Today on Hot Money, we'll discuss stocks like HDFC, IDFC Bank, GNFC, and we'll ask them for the top investment idea. Let's move on to the first one, and that is HDFC. Big fundraising plans by the company. A lot of foreign institutional investors as well as domestic funds there will be a preferential issue to them, followed by a QIP. Now, yesterday the market cap of HDFC hit the 3 lakh crore mark. What is in store for HDFC? Is the valuation right, or should someone switch to another housing finance company? We'll ask our experts. Dharmesh, what do you make of HDFC? The rally certainly was there. Is it fully priced in? Are the valuations now attractive, or should someone switch out of HDFC?
See, valuation for HDFC has always been attractive. It's never been overvalued. On the face of it, prima facie, it looks that it has been overvalued. So that has been the scenario for the last 10 years. So I don't think like 3-4% kind of an up move, fully prices in the kind of a valuation comfort which HDFC enjoys. So business is robust, asset quality is impeccable, management is impeccable, and the very fact that they are raising money shows the capacity which is lying in the market to be explored. Okay. So that is the reason why they are raising the equity levels, and major part of the money will go to the HDFC Bank to fund them for their expansion. So HDFC is still seeing a 20% plus kind of a growth in the market. So that is the potential they are seeing. And price to book value wise, it has been expensive stock on the matrices which we analysts look into. But that is the scenario. So safely, if you want to be invested in housing finance company, I still believe HDFC is one of the top pick. One should be invested. Compounding of 20% on a 3-year kind of a CAGR basis will be there. So it's a right buy even current levels. Okay,
at even current level, Dharmesh is indicating a buy. Chintan, what do you make of HDFC's fundraising plan and its plan to invest in HDFC Bank? How will that play out for the company?
See, 11,000 odd crores through a preferential share sale and approximately 1,800 odd crores from QIP.
Yes.
The entire plan for HDFC to raise this particular capital is primarily for 2 reasons. One, to fund in the insurance business. Second, to buy this stress asset in the real estate sector. Look at the growth of HDFC for last 1 year. It's already risen by approximately 50 odd percentage in terms of prices. When we look at the valuations, it is little expensive, trading at a 26 kind of a P multiple, and even the price to book value is at 4.5, which is way too very high. But the muscle of the company, the financial muscle itself, proves to say that when I compare HDFC Limited with its other 10 peers, the value, the volume of sales is at par with other 10 peers. Okay. Moreover, even the market capitalization is as good as the next 10 peers which are listed on the markets. This is one part of it, and there is a lot of uptick in the affordable housing space. Okay. So with the changing demography, a lot of consumer behavior changing towards buying their own independent house. I believe the stock really has got a lot of heat still left, and we hold a very complete, we completely hold a buy stance onto HDFC, and I would like to second Dharmesh's call saying that it's got a real potential of another 20 odd percentage.
And you are okay with the valuation, despite the valuation being high. You would not recommend someone to switch out of HDFC and move into someone which is trading at a lower price to book, probably let's say a Divan or an India Bulls or it can be anyone.
Yeah. So currently we do not suggest that, because HDFC Limited has always been a growth counter. But there is a lot of value that we are seeing into this particular counter, even at this point in time. So it has become a blend of both growth and value. at this time. So we certainly do not suggest a switch and to hold on to HDFC for all the investors who have held
Okay,
it.
so 2 thumbs up that are coming in for HDFC. Vinit, do you second their view in terms of HDFC being a powerhouse and it should be held?
Yeah, so the growth opportunity is huge. We have the government spending aggressively on housing. Affordable housing is a thrust area.
Okay.
So I think the growth momentum continues. You always be with the leader. And if you bought any property anywhere, the first call that comes to you is from a HDFC agent. So they've got their act. They're top of the line for marketing also. They're very aggressive. And they're investing in their subsidiaries. Normally they've gone through a route of divestment. But they're now reinvesting in their subsidiaries. So it shows their bullishness on the entire financial sector. And when the economy takes off, the first stocks that move are always the financials. If you track the Japanese bull market, out of the top 6 stocks were finance stocks.
Okay.
Then. So I think this is a must-have stock along with HDFC Bank.
Along with HDFC Bank. And what do you make of the rationale of investing in HDFC Bank? Is it a good move? Because they have to maintain that shareholding pattern.
So they want to
is there any other benefit that they're getting because of this?
So that franchise is growing so well. You know, it's growing at 18%. On such a large base. And if you track growth of SBI historically, SBI has also grown in the same way. Okay, so there is no reason to suspect that HDFC Bank cannot grow better than that. So there is hunger for finance, and both will do well. So it's perfectly justified in maintaining their stake out there.
Okay, so it's a triple thumbs up that's coming in for HDFC at this point of time, despite a big sharp move that we saw and a market cap as big as 3 lakh crores. Our guests do believe that the potential growth story justifies the high valuation that the HDFC has and should not switch out of HDFC into any other housing finance company. So HDFC remains the top picks as per our experts. Let's move on to the next one, and that is another M&A story that has panned out. That was the merger story between Capital First and IDFC Bank. Now, ever since the news officially came out, both the counters have actually gone down significantly. IDFC Bank has corrected almost 6 to 7% ever since the news officially came out, and Capital First is also trading with a negative bias today. So what should one do with the IDFC Bank? Was it a good merger? What's the way ahead? Vinit, what did you make of the merger?
So my view right now is neutral on this merger. The valuation is expensive, number one. Number two is that there are issues regarding mobilization of deposits and the corporate NPAs. So until we don't see traction out there, I think this merger is, for me, a neutral stance.
Okay. And what did you make of Capital First? What benefit? Will it get any kind of benefits into IDFC Bank?
See, once digitization kicks in, the survival is on the basis of cost of funds. You know, cost of funds which are high in the unorganized or the semi-organized sector, you'll see all of them move towards a banking kind of structure because you get the cheapest cost of funds. So, it makes sense for Capital First to merge into a bank, and IDFC is also looking to expand its franchise.
Okay.
So it's the best of both worlds for both the banks, both the companies. But for me, IDFC Bank, I would like to see, as I said, you know, the historical legacy fundamentals improve more.
And will it be for someone who's looking to invest? Will investing in Capital First be a better idea to play the proxy IDFC Bank rather than invest in IDFC Bank? Because that's what a lot of analysts did manage to suggest. So that's the
so there's another risk also here about a regulatory hurdle. So like we had seen the Shriram and the IDFC merger being called off. Okay, so there is that risk. So if you were to play Capital First based on the two stocks marrying each other, I would refrain from taking that view.
Okay, what about you, Dharmesh? What did you make of the merger? Who benefits more?
See, eventually it will be IDFC Bank which is going to benefit from this merger. And if you look at the initially, when the IDFC was split into IDFC and IDFC Bank, so that time again it was a 3-year call. Nothing materialized in the 3 years. That time also the very bullish views were there, right? 180 kind of a stock price for IDFC Bank, and talks about that was, you know. Similarly again, you are taken 3 years back. because this entire theme to play out will take at least 2 to 3 years. The best part is that had it been, Piramal, so that would not have made much sense to it, because both were in the same boat. So again, retail, franchisee base and all those things would have been a problem. With this merger taking to place, around 5 million kind of a customer base they have, converting, a person who is a borrower from your entity to a guy who has a savings account in your entity is a difficult task. It's not so easy, though it's a low-hanging fruit and ripe fruit to be, plucked, but it's a difficult task. Going by the track record of Mr. Vaidyanathan of Capital First, because when he, made Capital First, that time the wholesale to retail ratio was 80-20. And that time Capital First was into a deep problem and mess with all the NP and everything. He turned around. He brought NPA levels less than 1%, and the mix was 20-80. 20 was wholesale and 80 was retail. Same is what IDFC Bank required now. So now they want to go to 65-35 kind of a retail wholesale kind of a scenario going forward. So gradually it will come down. So my own sense is that I would give Mr. Vaidyanathan my own vote that he would be able to turn around this business. The only banking license which he was not having now, that is in place. But this entire story will take around 2 to 3 years time frame to pan out. As on the valuation front, if you go now, 41 would be FY19 discounted, price to book, because 40% is the dilution in the IDFC Bank equity which is there. And to have that catch up in play with ROE, and ROE is catching up, and because of low cost of funds of Capital First giving some accretion to the profitability, it will take time. So 1.6, 1.8 times price to book value based on FY20 estimates, if everything goes well, then it's around 40-50% kind of up move. Around 90-95 would be the stock price of IDFC Bank. So
on a merged entity.
On a merged entity, yeah. All regulatory and everything goes through, and you have a merged entity, and the business pans out as it panned out for Capital First, for IDFC Bank. And I would give my vote in favor of that it's likely to pan out, because economy is growing. There potential is there are a lot of opportunities to be capped, and this guy has this experience. He has turned around a business. The only thing is now he will carry it forward.
What should a holder of Capital First do now?
He should sell it, because the ratio is defined now.
Yes.
So it will keep on adjusting on a day-to-day basis. Whatever would be the price correction in IDFC Bank, Capital First will also correct accordingly. So there is now nothing left in Capital First, to my mind. So if I want to take a chance as an investor, I would rather buy IDFC Bank and play it out for next 2-3 years.
Okay.
Because 50% appreciation in Capital First is not likely.
Okay.
IDFC Bank still has that potential.
Okay, what do you make of it, Chintan? First of all, your view on this merger, and what should, if someone's holding an IDFC Bank share and someone who's holding a Capital First share, what should they do now?
So first of all, it's a strategic move from IDFC Bank. From being a pure play, an infrastructure financer kind of an image, it's now moving on to retail banking kind of a mode. When you look at the CASA ratio of IDFC Bank, it's merely at 8%, wherein the established banks, larger banks, have got 30% kind of a CASA ratio. Both the entities put together will have an AUM of approximately 88,000 odd crores. Now this is good enough to cater to 5 million population. When I look at this particular deal, it's a synergy which is going to get triggered in. But as other experts already identified, it's going to take some time. So at this point in time, the swap ratio looks more profitable towards Capital First as compared to IDBI Bank. This point in time, IDFC Bank at this point in time. So overall, when you look at the valuation of IDFC Bank, even today, it's very reasonable. But as I suggest, the synergy is yet to be kicking in. We currently hold a very neutral stance, and at this point in time, the deal sees a favor to Capital First as compared to the bank.
So you're saying that, so that's what I want to break it up. So let's say someone holds Capital First. He's saying that he should sell. What is your view? If someone is a shareholder of Capital First, the deal is announced, stock prices have already come down. At this stage, what should a Capital First shareholder do?
So I would not suggest a strong sell to a Capital First holder. The reason being, whenever there is a strategic deal, there is a synergy which will step into place. And we are really not sure of how fast the synergy is going to get into shape. So this point in time, hold is a right view for Capital First according to us.
I would like to just highlight one
Yes.
point, because Capital First stock price has already discounted all the positives into it at this current price level. Even if it would have been a standalone entity, so on the valuation matrix, 948 is the higher side of the valuation multiple. So there's nothing more left to Capital First stock price moving up on a standalone basis for next couple of years.
Okay.
Whereas IDFC Bank, there is a lot of scope out there. So that was one of the rationales.
Okay, so that's the view that's coming in on IDFC Bank. Mainly, Dharmesh is extremely bullish on IDFC Bank. Hold rating coming in from Chintan, and Vinit believes at this point of time that the bank actually has to prove itself before he takes a view on the bank. Let's move on to take a look at the next stock, and that is GNFC. Two contradicting news coming in. Yesterday, the big TDI price hike that happened, 8%, they took a hike of TDI prices, and that moved the stock up almost 10%. Now today morning, the company coming out with a notification indicating a fact that there was a gas leak in their TDI plant, and the plant has been shut down. So one day it's up 10%, it's down 8%. But what does this mean? Chintan, I'll start with you. Any view on GNFC?
Okay. So both the days, the price movement was purely on news based.
News based, yes.
I will discount this particular news for time being, because 10% upside yesterday and 8.5% of downside today is going to be a flat closing as to what it was 2 days back. GNFC, when you look at the consumption, the per capita consumption of the chemical industry in India is almost 1/10 that of the global players. So the sector certainly has got a potential. Last 3 years, the stock has already multiplied some 7 odd times in terms of prices, and last 1 year it is close to doubled. Lot of potential into it. Moreover, all the plants for GNFC have operated at approximately 100% of the full capacity utilization. The exports have already gone up to 320 odd crores. There's a lot of demand which is going to peak in, and this ideally happens to be the last union budget for the current government. We will see a lot of focus on agricultural as a sector, and even fertilizers for that matter. So at this point in time, we still see a lot of hit left into fertilizers as a sector, and we hold our bullish stance on GNFC.
Okay, it's a bullish stance coming in. Vinit, what did you make of GNFC? Let's discount the news. But I think the second news is more important. They have shut down their plant,
Yeah, so
and they
that will
haven't
have
given a date when they will reopen. It's indefinitely they've put it out.
Yeah, so there's uncertainty, market is slightly overheated, GNFC price has been discounting the price hikes very aggressively. So I think there's little room for more appreciation from these levels until you get the next price hike. But I don't think that will be coming, so I would book my profits in this stock.
But fundamentally, any view on GNFC apart from the news?
I think it's valued in all the entire. I think it's a valued play.
It's a value. It's already fairly valued at this point of time. What do you make of it, Dharmesh?
See, as far as GNFC is concerned, last 2 years, it has multiplied 10 times. 58 was the price, 2015 October, and now it is 540 plus. As far as the news is concerned, this is a temporary news. Fire shutdown, it will be rectified in few days, but the price hike is a permanent news as of now.
Yes.
As long as TDI demand is there. If you look at GNFC structure, the fertilizer component has not been making money for them. And their share has been subsequently rising. It was just a chemical play which they have been focusing on for the last couple of years, which turned GNFC into profitability. So the share of chemical has been rising, and TDI is one of the important raw material for all the foams, be it car seats, mattresses, everything. It is being used, and they have been able to raise the price hike, and the price has been absorbed by the industry. So that part goes. If I was a buyer in GNFC because of TDI price hike, I would be an aggressive buyer today on this news of a fire in the plant.
Okay.
So that's a small incremental, because insurance, everything is there, so that will be taken care of. So this is an opportunity to buy. But as far as valuations are concerned, I think it's fairly priced in.
Okay.
So 15-16% is the maximum growth which you can expect from a chemical and a fertilizer blend kind of a company going forward, and it's there. So from here on, with such a big run up in last couple of years, I don't think the stock will move further ahead.
Okay.
So, but 10-12% or 15% kind of a stock price return, if somebody is looking in the medium term, it's a good time to buy.
Okay, so that's the view that's coming in on GNFC. Chintan is rather bullish on the counter. Taking the news apart, fundamentally, he believes that there is potential growth that would come in. Dharmesh believes that it's fairly valued, but there could be a potential of another 10-15% upside. And Vinit does believe that at this point of time, GNFC is fully valued. He would recommend investors to book profit. Before we move on, here's a quick recap of all the guest views on the stocks that we've covered till now. Okay, so now we are asking our guest one investment idea which they should be bullish on for the next few years. So we'll start with Dharmesh. PTC India Financial, what's the rationale?
See, it's basically into finance of renewable energy segment. It's an NBFC company, got an infra status from the RBI. And this company was doing fairly well, 4 or 5 years back with almost nil kind of an NPS. But because of a glut in the power segment and renewable energy segment was hit. So few of the accounts turned bad, which led to a NPA rise to over 5% of GNP kind of a levels.
Okay.
According to management, this would be the last year of all the slippages, legacy problems NPA related, which is there. No fresh slippage is being found in this company. So going forward, 20% kind of a CAGR on the AUM of the loan book growth has been for the last 5 years, and which is likely to be so. 12,000 odd crores of loan disbursement has been there. 21,000 plus of sanction is there. Okay. So that trajectory for next couple of years is already there for 20-21% kind of a loan growth. Government's push on the renewable energy segment with the incentives been given, things will be much better out there. So my own sense is that next quarter, this should be the last quarter, so one should be buying this stock in a staggered manner. Okay. So 38 rupees is the book value of the stock now. Next couple of years, you can have a CAGR of around 20-22%. Okay. So the book value would come to by FY20 estimates 53-54. Even if you take 1.2 kind of a price to book for a company which should be growing and then asset quality will be taken care of, 64 would be the price target. So plenty of scope from current price to
so it's trading at one time book currently.
Exactly. Yeah, on a TTM basis.
Yeah. So my second my just points on this is firstly, what is the visibility? Which are the big projects that it is looking to finance where money will come in? Because what we've seen is that renewable, the government is saying there is absolutely nothing happening in solar power. Yeah. Prices have absolutely crashed. So I just wanted to know where will the visibility come in?
So solar power prices being crashing is a big incentive for solar power producers. Because earlier that was a disadvantage because merchant tariff was much lower than solar power, so nobody was buying that. So now it has become competitive. Okay. And solar panels, see, if you look at PTC India Financial, they are not into big financing projects. Okay. Their projects are small ones. So the players won't be identifiable to you. The big names won't be there in the industry. Okay. But solar panels have been, housing societies and everything. They have been in a big way getting, a very good traction out there. So the players who are providing them, small players, 100 crores, 200 crores, 300 crores kind of a turnover kind of a companies are the main, clients of PTC India Financial Services. Okay. So it would be a staggered, and that's better because the concentration risk is not there. Earlier they did have a concentration risk, so that was the reason why a couple of accounts added to such a big NPS. And Mr. Ashok Haldia, the current chairman, he's a very aggressive and a stable guy. So I think.
Now, has he given any indication of what level the NPS he plans to get it down to?
In the last commentary, the con call which was there on Analysts Meet, that is what he said. This should be March should be the last quarter of NPL provisioning, and from here on, from the first quarter FY19, there won't be any fresh slippages out there. Okay. So 5.4, 5.5 is the highest gross NPA which you will see on the present basis. Okay. So that's on the book of around 12,000 odd crores of the year, and 10% is the yield of the funds which is there. Their NIMs are much better, around 5% kind of a NIMs was there, which has come down because of provisioning to 4%. Okay. So you're looking at a target price of 65 approximately
on PTC India Financial. So that's the first stock that Dharmesh spoken about. Chintan, you like Cheviot. I think the entire jute industry, not only Cheviot, you made Gloucester, Ludlow, all of them have had a stupendous rally. First of all, what's the rationale of Cheviot? Okay.
So Cheviot is a very small company. Yes. The quest was to identify one of the multi-baggers, wherein people can, wherein the investors can really build their wealth over a period of another 3 to 4 years span of time. Government of India has already identified that approximately 17 items has to be packed only in jute. Yes. That's where the entire rally into jute as a sector has come in. Now these 17 items are predominantly food grains and some of the agri commodities. Yes. Cheviot company is not only into packaging material but also into into fancy materials of jute, handbags and a lot of things. It has got its global footprints as well. So, and the integration of the company, apart from selling manufacturing, they also have the production of jute. And end-to-end capacity, again, so this makes the stock very attractive. Practically, it is a zero debt company. It's completely a debt-free company, and trading at a P multiple of only 12.
Okay.
So this makes stock look very attractive, and the identification of this stock is purely because of the fundamental spurt in the demand which is going to come in through the regulatory norms. And going forward in future, again we see that there are some more items which government has already indicated that they will include for the jute packing, and that's where the entire demand of jute industry will come into place.
Okay. Secondly, is there any risks, that downside risks that you see on this counter? What could be the potential risks that?
So onto this counter, we see potential risk of it's highly competitive kind of an industry.
Yes.
So most of the companies which trade into this particular sector are largely small cap companies. So the risk is that one of the accounts, a major accounts, in case if there is any, because they also have a global footprint. So if one of the accounts goes completely burst in terms of the revenue yield, that's where the major setback for the company comes in, because there is practically no debt. But whenever there is a pressure onto any kind of a payment, the stock price, the company, the profitability is certainly expected to take a hit.
Okay. And valuation wise, compared to, if I don't know if you've looked at Gloucester or Ludlow, how would this be in terms of the other competitors?
So when I look at the other competition, most of the players in this sector are at a PE multiples of 15, 17, 19, and that's about it.
So
that's
this is the cheapest.
Yeah. So this stock happens to be the cheapest in terms of valuations.
Okay. So Cheviot is a pick that Chintan is saying, debt-free company in an area wherein government is focusing a lot on to packaging. Agrees already come in, and he believes others could also come in. And Vinit, again, cement. I think you're too bullish on cement. Star Cement now. What's the rationale?
Okay, say it's a 3.4 million ton plant.
Okay.
Adding 0.3 million this year and 1.2 million in FY19.
Okay.
It will come in stream in FY20. So you're just a shade under 5 million ton.
Okay.
And on a replacement cost basis, if we look at EV per ton, it's costly at $156 per ton. Other 5 million ton typical players are sub 90. But if you see it on valuation basis of EV by EBITDA, it's in line with other stocks of comparable capacities like Heidelberg, Sanghi Cement. We are bullish on Sanghi Cement, so that's available at around 11 times EV by EBITDA. This guy is available at about 9 times EV by EBITDA FY20.
Okay.
But if you see the thrust of the entire, if you see Bharatmala allocation, compared to Northeast, there's a very heavy allocation. And pricing is very strong of cement in Northeast. There's natural deficit. 308 is the price per bag. This plant is working at 82% utilization. So once you start hitting the sweet spot of 85+%, the prices, the pricing play and the entire delta comes to the EBITDA.
Okay.
And today he's got the highest EBITDA per ton across the country.
Achha.
So despite having the highest freight cost, okay, his EBITDA per ton is the highest. And when you're adding capacity, which is 1.2 million tons, you're going to see a lot of volume growth plus pricing growth. I believe that prices could move to around 350 plus levels over the next 2-3 years, given the aggressive infra rollout out there. And if he can manage to bring the, what I naturally feel is that once concentration of projects start happening in the Northeast, the freight cost could come down a bit. So you'll have a double impact of volume growth, pricing growth, and also cost efficiency.
Where is this plant located?
It's in the Northeast.
It's in the Northeast, so it's catering basically.
Yeah.
Any target that you believe that could?
I think I would see it as a...
Is it a compounder type of stock?
It's a compounder,
stock?
yeah. It's a portfolio stock, it's a compounder, and the target is open.
Okay, so that's the view that's coming in on Star Cement, the play as far as Northeast is concerned. With that, before we wrap up, here's a quick look at which other stocks our guest had recommended for an investment perspective. Okay, Vinit, Dharmesh and Chintan, thank you so much for coming into the show. With that, it's a wrap on today's Hot Money. Ask BQ comes up next. Stay tuned to Bloomberg Quint.